Good day, fellow investors. Yesterday I shared my opinion about Ray Dalio, how I don't really agree. We are simply different on the investment style. I am for long-term compounding and value investing. He is for stability because volatility is risk. That's a big difference. But when it comes to explaining the macro, explaining the current economic situation, I really believe that there is no one who is better than Ray Dalio. And in this video I really want to discuss his last newsletter on LinkedIn, and if you want to subscribe to something, subscribe to his newsletter, because as I said, it is the best explanation of what's going on in the markets, and he has this power of simply explaining the risks and rewards we have to think about. So let's immediately start with his letter and why he thinks that reducing inflation will come at a great cost. Stagflation. Stagflation is economic stagnation or recessions with inflation. And then he starts in his letter how hearing supposed experts talk about what's now happening in the markets and economy is like listening to nails scratch against a chalkboard, because they are typically saying incorrect things in an erudite rather than common sense way. Markets and economic movements are driven by much simpler and more common sense linkages than most people articulate. I try to describe the most important of this in my 30-minute animated video, how the economic machine works, and I try to lay out for you how I saw the paradigm shifting over the last 18 months in the changing world order, the new paradigm, which have more of the specifics that I will cover here. Here I just want to talk about fighting inflation and what's happening pertaining to it. And the key things that Ray Dalio shares here are that once debt is another person's asset, so there is always this connection then that when you go and fight inflation we forget. And the second is that one person's spending, if you fight inflation you reduce spending, is another person's income. So there is no way to fight inflation without dealing with debt or another person's assets, or spending or another person's income. There is no free lunch when it comes to the economy, no matter how it might look, because the news is all about the Fed and what the Fed can do to save us. I'll put the link in the description below to these two videos from Ray Dalio. I'm sure you have seen them, but it's never bad to watch them again. And now, more specifically, I now hear commonly said that inflation is the big problem, so the Fed needs to tighten to fight inflation, which will make things good again once it gets inflation under control. I believe this is both naive and inconsistent with how the economic machine works. That's because the view only focuses on inflation as the problem, and it sees the Fed tightening as low-cost action that will make things better when inflation goes away. But it's not like that. The facts are that prices rise when the amount of spending increases by more than the quantities of goods and services sold increase. And the way central banks fight inflation is by taking money and credit away from people and companies to reduce their spending. They also take buying power away by raising interest rates, which increases the amount of money that has to go forward paying interest and decreases the amount of money that goes towards spending. Raising interest rates also lowers spending because it lowers the value of investment assets because of the present value effect, which he's not getting into here because it would be too much of a digression, which further lowers buying power. My main point is that while tightening reduces inflation because it results in people spending less, it doesn't make things better because it takes buying power away. It just shifts some of the squeezing of people via inflation to squeezing them via giving them less buying power. So the Fed doesn't have the solution to inflation. If there is less inflation, of course, you will have less spending power. So at the end, it is an even game because the Fed can't help you. And as Ray Dalio says, the only way to raise living standards over the long term is to raise productivity, and central banks don't do that. And then he goes more on what do central banks do. So of course, trying to smoothen those cycles with higher rates, shorter rates, and then we have the short-term debt cycle and the long-term debt cycle that typically lasts 75 years, give or take 25. That's because most everyone wants the ups and not the downs. So the stimulations and debts that central banks produce typically add up over time to produce more ups and downs until the debt, assets and liabilities get unsustainably large, at which point they have to go down via some mix of inflation due to money printing to reduce the debt burdens by monetizing them, which is inflationary, debt restructuring and paying the debt service in non-depreciated money, hard money, which is depressing. That is what we have been experiencing. It's why debts have been increasing relative to incomes at the same time as each cyclical rise and each cyclical decline in interest rates since 1980 has been lower than the one before it until interest rates hit zero. And since then, each central bank printing and buying of debt has been greater than the one before it up till now. Most fundamentally, and this is the key here, one person's debts are another person's assets and one person's spending is another person's income. Which means when there are a lot of debt liabilities and debt assets outstanding, it becomes impossible to make things good for both debtors and creditors. And when the credit debt creation is curtailed to bring spending in line with incomes, that causes investment, asset prices and incomes to fall, which cuts spending and is depressing. And then discussing what should central banks do. Well, they should use their powers to stabilize markets, keep things stable, but they don't do that because it's very hard. As the quote said, the Fed should take away the punch bowl when the party is at its best. And they are not doing it because why would you take the punch bowl away from things that are great? Then you just keep stimulating, and then you get these cycles, and then unfortunately, at some point, that has to revert to the mean because it doesn't impact productivity. And that's what Ray Dalio is saying. So, in summary, the main points are that there isn't anything that the Fed can do to fight inflation without creating economic weakness. With debt, assets, and liabilities as high as they are and projected to increase due to the government deficit, and the Fed also selling government debt, it's likely that private credit growth will have to contract, weakening the economy, and over the long run, the Fed will most likely chart a middle course that will take the form of stagflation. So, what does this mean? That the Fed will still be stimulative. If interest rates are 1% and inflation is 8%, that's still an extremely stimulative environment. So the Fed will likely chart a middle course where it tries to keep things stable in an inflationary way to reduce those debt pressures, taking away income and asset value from others. And that's something also we'll discuss 2 days from now, discussing how the Fed might chicken out, as Seth Klarman said. And now, very important to notify here, this is the current situation. The Fed might change its way of working, the politicians might change how things work, so everything might change, but from a current perspective, I can't find better explanations in writing, especially. Don't go to interviews because they just take things out of context. In writing from Ray Dalio. So really subscribe to his newsletter, and if you do that, that's the message. That's my job done with this video. Thanks for watching, smash that like button if you enjoyed, and I'll see you in the next video.